This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, now let's go back to the numbers and look at capital asset pricing model. In the last chapter, portfolio theory, I explained the basic logic leading to it, that it's the systematic risk of a share that determines the return shareholders require. And so let's see, there's a few calculations here, which most of them I think are very straightforward, but let's see how we can go about, if we know how risky the share is, the systematic risk, how we can get the required return. Now, first of all, is how we go about measuring the systematic risk. And this is quite good fun. Instead of trying to put a number to it and saying, oh, the risk is 10%, 12% or something, we always measure it relative to the risk of the stock exchange or the risk of the market as a whole. Now remember, we are only talking about systematic risk. I'm not going to keep repeating that. But by the market, we mean the stock exchange overall. And I'm sure you know that I think every country with a stock exchange, they quote an index, a sort of average for the stock exchange. In England, there's something called the FTSE index. They publish a number each day, which is an average, for all the shares, or certainly the 30 biggest shares. In America, Dow Jones index, that sort of thing. And the stock, it is sort of an average for the stock exchange, and it does go up and down. Again, with economic conditions. If the economy is doing well, the average goes up. If the economy is doing badly, it goes down. But because it's an average, well, first of all, the market as a whole is risky. It doesn't just stay at one average, it goes up, it goes down. But because it's an average, always some shares are more risky and some shares are less risky. So, if the economy is doing well, all shares go up. If it's doing badly, they all go down. But some shares go up and down more, some shares go up and down less. And the market as a whole, the stock exchange, is just the average of all of them. And so that's how we measure it. And I'll tell you how to get the figure in practice later. But in the exam, you'll be given it. The measure we call the beta. And the beta measures how risky it is relative to the market as a whole. So, for instance, if we have a beta of 1.5, it simply means it's 1.5, this particular share is 1.5 times as risky as the market as a whole. On the other hand, if you had a beta of 0.8, it would simply mean it was 0.8 or 80% times as risky as the market as a whole. And so on. It's terribly simplistic. As I say, we're not worried about calculating these betas. You're given them in the exam, and for major companies they are quoted. You can find them on the internet. Although a lot of companies charge for telling you what the betas are. But all it is, the beta, how risky it is relative to the stock exchange as a whole. 1.5 times as risky, 0.8 as risky, 0.2 as risky, twice as risky, and so on. And so if you understood me, what do you think a beta of 1 means? Is a beta of 1, it's 1 time as risky, it's got the same risk as the market. And I keep saying, it's the last time I'll say it, but by the market we mean the stock exchange as a whole, the average. And finally, what would a beta of 0 be? A beta of 0 times as risky. It would mean there was 0 risk. Or we call it risk-free. Now, in real life, there are no investments which are completely risk-free. The nearest we've got to it, and what would be used in the exam as an example, are short-term government securities. Government borrowing, you can lend money to the government, buying government securities. And the reason they're the nearest thing we've got to risk-free is that A, they're paying fixed interest. So the income's fixed. Remember, it's fluctuations in income that create the risk. Here you're getting fixed interest. But also, if they're short-term, the chances of the government collapsing and not paying the interest are obviously fairly remote. I mean, it could happen, but it's the nearest thing you've got to something with no risk. You know, if you buy bonds in a company, all right, you're getting fixed interest, but there's always a risk that the company may collapse and you lose your interest completely. So that's not very likely. There is low risk to be a low beta, but they're not completely risk-free. If any of you are thinking, is it possible to have a negative beta? In theory, yes, but never in the exam, and in fact, even in real life, it's extremely rare, because the point is that as the economy does better or worse, all shares do better or worse. Just some fluctuate more, some fluctuate less. To have a negative beta would mean that as the market did better, your share actually did worse, or if the market did worse, your share did better, which doesn't really happen. All shares tend to go up and down together. So I'm not going to waste any more time there. In the exam, it certainly wouldn't be negative. Anyway, I'm going to discuss what a beta is, given that that's how we measure the risk. How do we determine what return we want for a certain level of risk? Well, there's a formula. It's given on the formula sheet, but it really is so basic and, well, it's just always somewhere in the exam that I really think it should become automatic, if only because the way they type on the formula sheet makes it look far more complicated than it is. If you look at the note, ERI equals RF plus beta I. Oh dear, I hate the way they write this. ERM minus RF. What it means is the return we want from the investment. First of all, as a base, it'll always be more than risk-free. You'll be told the risk-free rate, or you'll be told the return on government securities, which we assume are risk-free. And so let me illustrate it, in fact, with example 1. Q has a beta of 1.5. The market's giving a return of 12. The risk-free rate is 5. Well, I say again, you'll be given the risk-free rate. And so always we say the return we'll want will be more than the risk-free, but how much more depends on how risky. If it's not very risky, we won't need a lot more than 5. If it's very risky, we'll need a lot more than 5. As to how much extra we want, how much premium we want above risk-free, we say, well, it depends on the risk. This has a beta of 1.5. And we say, we will want a premium above risk-free, but since this is 1.5 times as risky as the market as a whole, we want a premium 1.5 times as risky. 1.5 times the premium the market's giving. The market's giving a return of 12%, which is a premium above risk-free of 7. It's giving 7% more than risk-free for the risk of the market as a whole. We're 1.5 times as risky, and therefore we want 1.5 times the premium. The risk-free plus 1.5 times 7, we want a premium of 10.5, and therefore we'd want a return of 15.5%. So that's the return shareholders would want for that level of risk. And therefore that would be the cost of equity. If shareholders want 15.5, the company has to pay 15.5. This is the other way, in fact the more common way in the exam, of calculating the cost of equity. But it really is as simple as that. It's the risk-free always plus beta times whatever premium the market's giving. This, incidentally, 12 minus 5 is the market premium. And do read questions carefully. Sometimes, like this one, it'll say the market's giving a return of 12. So the premium, 12 minus risk-free, is 7. Other times, the question might actually say the market premium is 7, in which case we add on 1.5 times 7 directly. Okay, well, I'm not going to waste time giving you loads of examples on that. We've got 1 or 2 more later. Well, there's hardly ever going to be an exam without that somewhere in it, but as part of a much, much bigger question. Less likely, but has happened, you could be asked to effectively do it backwards. Look at example 2. T plc is giving a return of 20%. So we know what return it's giving. The stock exchange as a whole is giving a return of 25%, so there's the market return. And the return on government securities, the risk-free rate, is 8%. And so rather unusually, but as I say, it could happen, it has happened. This time, we're asked to calculate what the beta must be. So instead of being given the beta as usual and calculating the return, here we know the return. We can just work backwards. And so certainly not hard. The return, which here is 20%, is equal to the risk-free rate, which is 8%, plus beta, which is what we're trying to find, times the market premium. Well, the market as a whole is giving 25, the risk-free is 8, and so the premium is 17. So subtracting 8 from both sides, 20 minus 8 is 12, is beta times 25 minus 8 is 17. Beta, therefore, 12 over 17, the beta would be 0.71. We usually put it to do decimal places, but small bits of rounding in the exam don't matter. So I don't think that was too bad, quite frankly. Again, much less likely, but just in case. One of the reasons that I did show that is, although you'll never be asked to calculate a beta in any other way than what's there, and normally given betas, as I say, they are published in the papers, the way in real life they're calculated is effectively what I've done there. But just to look at one day would be very dangerous. You know, nothing works that perfectly. What they do in real life is look over a long period, you know, perhaps look over a year. Day by day, returns change, you know, so what's the market been giving, what's a share been giving? And and effectively do an average, do what I've done there, but over a long period. I say on any one day, things could be distorted and not give a sensible answer. All right, well, that's always there. Another thing that's very, very common in the exam, for various reasons, is combining investments. Now, there's an easy rule here, but make sure you've got it. Combining investments. Let me illustrate with this little example, and then I'll make up a new one to show you how it tends to come in the exam. Mattis decides to invest his money as follows. He's going to put 20% in A, which has a beta of 1.2. He's going to put 40% of his money in B, which has a beta of 1.8. 30% in C, which has the same risk as the market, and 10% in government securities. So he's mixing together investments with different betas, and the first thing we want is overall, for investment of all his money, what's the overall risk, the overall beta of those four investments? Well, no problem. If we do mix investments together with different betas, the overall beta is simply the weighted average of the individual ones. We weight by the amount invested. So here with A, B, C, and government securities, the betas, A is 1.2, B is 1.8. C has the same risk as the market. So think back to what I said earlier. It's 1 times as risky, its beta is 1. Government securities, I said, are the example of risk-free. If it's risk-free, the beta is 0. Well, the overall risk that the guy's having is the average of those. Well, we weight it by the amount invested in each. So in A was 20%, in B 40%, in C 30%, in government securities 10%. And so multiply up and add to get the weighted average. 20% of 1.2, I always do something stupid here, so I'm going to use my calculator, is 0.24. 40% of 1.8 is 0.72. 30% of 1 is 0.3. And of course 10% of 0 is 0. So the overall beta uh, 0.24 plus 0.72 plus 0.3 is 1.26. Which I think is a reasonable enough answer. I mean, just not these silly answers, but look at it. 60% of our money is invested in companies where the beta is more than 1. And so I'm not surprised we end up with a beta more than 1 at 1.26. Now, in fact, this exercise is quite common in the exam, but effectively done in reverse. Suppose I told you this, a little puzzle for you. Our company has 2 divisions doing different things. One part of the company builds cars, the other part of the company makes desks. You know, 2 completely different parts to the company. One division has beta of 1.5 and is 20% of the business, the overall beta of the company is 1.6. What I want to know, what is the beta of the other division? So it works just the way as an individual investing, with two divisions. One's 20% of the business, the other one, I don't think I'm spoiling it, is 80% of the business. The overall beta will be the weighted average of the two individual betas. But here, instead of asking you to calculate the overall beta, I've given you what the overall beta is. I've told you the beta of one division. I want to know the beta of the other division. Now, I'm tempted to stand here with my mouth shut until you've done it yourself, but I've no way of checking. As I've done a couple of times before, if I were you, I'd pause the lecture, have a go, then start again. There's no point in just listening to me all the time. But anyway, I hope you did pause and have a go, but in which case check. We have two divisions, Division 1, Division 2. The beta of the one we know is, I've lost it, 1.5. The other one, I don't know what the beta is. That's what we're trying to find out. I'll call it X. The overall beta would be the weighted average. So the first division is 20% of the business. Second division, therefore, 80%. Well, 1.5 times 20% of 1.5 is 0.3. 80% of X is 0.8 times X. Add them together. The total, well, we know what the overall beta is. It's 1.6. So it's now, I hope you'd agree, fairly simple algebra, that 0.8x must equal 1.6 minus 0.3, which is 1.3. And therefore x, the beta of the other division, must be 1.3 divided by 0.8. Uh, 1.625. I should be fair, 1.62 or 1.63. I've said a bit of rounding doesn't matter. And is that a sensible answer? If the second division is 1.6 and the first division is, sorry, 1.625 and the other division is 1.5, the overall beta must be somewhere in between. Well, it is at 1.6. Now again, very difficult with exam questions because one question will test you on so many topics and I can't do them all at once. But it's very common for that to be part of a question. You know, having worked out the beta for that division, I could say, well, what return do we need from that division? I could use the 1.625 in the earlier formula to work out the return needed. All right, now I don't want this section to be too long, otherwise you fall asleep. I'm going to break it into two. But before we stop this lecture and then come back and finish the chapter, the next section of the notes, a quick thing, it refers to alpha values. Now these used to be mentioned a lot, but recently they've not been mentioned at all. But they could be. They're mentioned in real life, and it's very, very easy. It simply relates to the fact that even though I think we all accept that capital asset pricing model works, things aren't perfect in real life. And although it may work overall, from day to day, you wouldn't be surprised if it didn't work out exactly. Let me show you what I mean. Look at example 4. D plc has a beta of 0.6 and is giving a return of 8%. The market return is 10 and the risk-free rate's 4. So according to capital asset, what should the return be? In theory, the return should be risk-free 4 plus beta 0.6 times the market premium, 10 as against 4, which is what? 3 points. Is it? I think 7.6%. So that's a return this share should be giving. But what return is it actually giving? The actual return is 8%. Now, of course, I said a minute ago that the stock exchange isn't perfect, and that from day to day, I'm not going to be too upset if capital asset doesn't work exactly. Some days the return might be a bit more than it should be, other days it might be a bit less than it should be. Here, it's a bit more than it should be. Well, all the alpha value is the difference between the two. It's actually giving 8. It should be giving 7.6. So today, it's giving 0.4% more than it should actually be giving. Come back next week and it may be giving 2% or 0.2% less than it should be giving. So that's all it is. In a perfect world, alpha would always be 0. In the real world, I keep saying, things don't work perfectly, but you would expect, if you looked over a long period, you would expect the average alpha value to be 0. Some days it gives a bit too much, some days a bit too little. Overall, you'd expect it to average to 0. Now, one other thing there, if at the moment it should only be giving 7.6, but it's actually giving 8%. Well, now would be the time to buy that share. Think about it. If it's giving more than it should be doing, we accept overall capital asset works. And remember, shareholders change the market value to get the return they want. Well, it's currently giving 8. That's going to change. It's going to fall because it should be giving 7.6. And if shareholders only wanted 7.6, the market value would go up. So this share is actually undervalued. It's currently, the market value is lower than it should be. And so now would be the time to buy for a positive alpha. If it had a negative alpha, it'd be the other way around. Then perhaps it would be time to sell. Anyway, a relatively minor point. As I've said, alphas haven't been mentioned for ages in the exam. But the arithmetic's desperately easy and they certainly could be mentioned. Alright, there is one more bit to deal with in this note, which again is critically important for the exam. It's to do with gearing. But I said I wanted to break the lecture into 2, so I'll stop here. The next lecture, part 2 of this chapter, and we'll deal with the effect of gearing.